Okay. Hi, everyone. I am here with Tina Tamboer. I'm super excited. She has graciously done this with me while on vacation. So she's in a hotel room, and I thank you for that, Tina, very much.
You're
But
welcome.
I wanted to get on here because I think some of the things in the media that we're hearing and that we're seeing are a little misleading. The market, the big thing right now is that the market is cooling. The market's
Mhm.
cooling. And I saw an article, I'm going to bring it up here so we can talk about it a little bit, in Redfin, that the housing market and the West Coast hubs and Zoom towns cooling fast. So tell us what are your thoughts on that, Tina?
Well, I just think it's a little outdated, if you will. We were cooling fast for sure. From about March of last year, we saw a major shift, and obviously all the way through to December. But I could say we stopped cooling right around then and started to come back into a balanced market and a seller's market.
Right. What's interesting is this article, just so everybody knows, this article was written about 3 days ago.
Yeah, yeah. So it's not that it's wrong, it's just late.
Right.
So, in terms of what they're using, they may be using some sales data. It depends on what they're actually measuring, whether that's price or whether that's, are we a seller's market, buyer's market, or are they measuring the number of sales per month? If they're only looking at sales per month, then you could definitely see a major cool off on the real estate market. Absolutely.
Well, and I think what's interesting in that article is that one of the things they're talking about is the tech hubs, right?
Mhm.
That those tech hubs that really exploded, that those are now seeing this shift in the market. And a lot of people don't think of Phoenix as a tech hub, but in the last few years, I've seen it multiple times that we are now kind of being called the Silicon Desert. And we have a lot of tech coming here. I know
Mhm.
it's we do, but it's nothing like San Francisco or Seattle.
Right. And it's probably more geared towards semiconductors than it is towards, there's obviously programming and, Facebook and Google and all of that internet based type technology. But the technology that Phoenix is getting known for is not along those lines. It's more along the lines of semiconductors and specifically manufacturing of
Right.
semiconductors. And that market is not slowing down. And that is a massive growing field for us. In fact, that field and the pay that comes with it is upscale for Greater Phoenix compared to San Francisco and, those types of Silicon Valley cities.
Right. Oh, and I saw an article from the Phoenix Business Journal just today that you were quoted in about that.
Oh.
Yes, I know. I know. Oh,
Yeah, the semiconductor
you
industry
get
is
quoted in
big.
all of these publications, and you forget where you were quoted.
We talk and then we move on with our day.
Right. Right.
Comes up
Right.
later.
Yeah.
So,
So
yeah, so I would say that one of the things that's different between Phoenix and these other cities is that A, we're very, very young, and B, we're actually growing. We're not seeing a net exodus from our city. We're seeing a net inbound migration. That is a big difference between us and Seattle, Portland, San
Austin.
Francisco, New York, even Chicago, even. We're having people move here instead of move out. And that's a big key because that means that we do still have the demand for the houses here. It could be suppressed. They could be renting for a while as they move here and then they find out where they want to live. But for the most part, we're not seeing a decrease in demand per se. We're seeing a suppression of demand. And that's totally different from what we saw, say, in 2006 and 7, when we literally had a lot of what we call false demand. False demand are people who are going to buy homes and they have no intention of living in it and no intention of renting it out to somebody who's going to live in it. They are flips, which means that when you have a flip, then you have two transactions for the transfer for one transfer. Does that make sense?
Right.
The seller
Yes.
to the final buyer.
Yes.
And so when that middleman pulls out, you'll see your sales data drop as if that was real demand. And all you're really doing is dropping to where your true demand really was.
Right.
So as far as cooling goes, last year over the course of the June through today, what we have seen are large flip investors such as Open Door, OfferPad. If you go back to 2021, Zillow, and
Yeah.
they have, but for the most part, OfferPad and Open Door pulled out of the market since June. And when that happened, all of those transactions, now the seller to the buyer doesn't have one extra person or entity in between there. And you're seeing that sales volume drop. And it makes it look like our market's cooling overall. And it's not exactly.
Yeah. Well, and it's funny. I have conversations with people about that, and buyers and sellers that are coming either in the market already or coming into the market. And it's like, well, what's going on with the market? And I'm like, it is different. However, when you're looking at homes, if you're looking at a home in a great location and that has been updated and that is priced right,
Yeah.
it still could get multiple offers today.
Yeah. They're there. The buyers are there. They're circling. The fins are there.
Yeah.
What they're experiencing though is stale inventory. So a lot of what's on the market today is kind of been there a while, and there's no pressure for sellers to reduce their price if there are very few new listings coming on. So here are a couple of stats to know. We are at the 4th lowest supply count we've seen going back at least 18 years.
Yeah.
We are at the 3rd lowest contract number of escrows waiting to close, listings under contract. We're the 3rd lowest. And the lowest before that was 2007 and 2008. So it's easy to compare us to 2007 and 2008 if you're looking solely at the demand side of things, the contract activity. But you can't compare us to 2008 if you are looking at supply. Because in 2008, we had 56,000 listings in the MLS, compared to now 13,000 in Greater Phoenix.
Right.
So not comparable at all. And so what happens when you have low supply and low demand, you actually get, for us, a seller's market, not even a balanced market right now, still a mild seller market, which means mild, boring price appreciation.
Right. Well, and it's like, I just want to bring this up because this is the top 17 markets in the Valley, and it shows where they are. And I mean, when the market shifted, right, May was our peak of last year. And when we started shifting, there was an awful lot more red on this chart than there is now.
Yes. In fact, we actually started to shift in the Cromford Market Index. And for anybody who hasn't seen this before, anything over 110 is considered a seller's market. Okay. If you're between 90 and 110, you're considered a balanced market, which means your annual appreciation rate will somewhere mirror the rate of inflation. So prices are going to move towards the rate of inflation. Okay. Whatever that happens to be. So when you are over 110, it's expected that you will do better than the rate of inflation. Okay, which for us, what are we at inflation right now? 6%. They don't get very excited over 6% appreciation, but I guess now it's better than negative appreciation, right? So the thing is that the market will, is always trying to move towards balance in some way. But at this stage of the game, we are seeing the lowest we've ever seen at the Cromford Report, which is going back to at least the year 2000 in the number of new listings coming on. So the issue is that we are bringing on about 1,600 new listings a week, but we are selling about 1,300 a week, and we're canceling another 360. So we are not bringing on enough new listing inventory to satisfy the sales and the cancellations and expireds. And we do not have high cancellation or expired numbers by far. They're normal. It's just that our new listing counts are so low, it's actually causing our supply to drop, which has dropped now 32% since October.
Right. And that's the thing, is that everyone's talking about that. Like, oh, well, but your inventory's up so high. It's really not. In the grand scheme of things, our inventory is still low. And the problem, and it's going to perpetuate, is that all those people that bought homes at low interest rates have no real reason to sell.
Right. Yeah. I mean, there's that going on. So here's another little thing we've got is that the new inventory that is coming on, we look at builders for a lot of that. Builder activity in the MLS is now 20% of all actives right now. That means that the rest of them are resale. Out of the resale sellers, about 67% have owned their home for at least 2 years. So that means that they're not really super desperate. They're not in short sale situations. They're not in pre-foreclosure, for the matter, none of that desperation. So they can pretty much just hang out and wait and be patient. They also can support, helping a new time homeowner into their home. So they don't necessarily have to take a loss on their home, in terms of the long-term appreciation rates. I mean, just think about it. If you've owned your home for 6 years, which at my age goes by really fast. Wow. 6 years, you're looking at 90% total appreciation on your home, 3% in concessions to help somebody buy down a rate or pay for repairs or anything like that is not necessarily going to break the bank for many of these sellers. And they still will have a pretty good down payment for whatever their new home is going forward. So it really depends on what their situation is, where they're moving, whether or not the home they're buying is, if they have a nice big down payment, what that looks like with the new mortgage rates as it stands. But, interestingly enough, when times like this happen, similar to 2008, at the end of 2008, FHA stepped up, if you remember. FHA stepped up. They raised the amount of loans somebody could get. But what they introduced really was the renovation loans. Do you remember that? Not only did we have
203K loans?
Yeah. So we had a first-time home buyer credit where the government, gave a tax credit for first-time home buyers, which, by the way, they redefined as somebody who hadn't owned a home in like 3 years. Born again, new
not
home.
Really a first-time home buyer.
Yeah. And then they introduced the renovation loans. So all of these homes that were foreclosed on and were in terrible shape, kitchens were ripped out, plumbing, wiring, oh, you wanted electricity with your home, that sort of thing. They were able then to get these renovation loans and pretty much bring that property up to par per FHA standards and get an FHA loan and get into their first house. And of course, they were very, very affordable back then. So now, flash forward here, we're still getting into the same issue where we've got some affordability issues. The FHA costs went very, very high after the foreclosure crisis. So FHA now has 3 benefits, actually 4 benefits right now. So the first one is that they raised the loan limit by, for us, over, I think it was $70,000, wasn't it? It's up to $530,000 now.
It was significant.
Yeah. So it increases the buying power of an FHA buyer. Also, the mortgage rate is on average about 0.5 point below conventional, which saves money there. Also, you can, in many cases on FHA, a seller can contribute up to 6% instead of the 3% on conventional. So you can get a little more help from the seller. And on top of that, now they've reduced the mortgage insurance premiums. So if you're first time getting a $400,000 home, which would be for Phoenix, right?
Right.
You could save $100 to $200 off your payment. So in times like this where the investors are kind of pulling out, they're, maybe even luxury might be stalling a little bit because of the uncertainty of the marketplace. This creates quite an opportunity for first-time home buyers that would normally get kicked to the curb at this time, in favor of stronger buyers, cash buyers even. And it's also causing some buyers that would normally be conventional to go for FHA.
Right. Because it might work out better for them in the long run. So I'm going to put this question up. I want to get your take on it. So they asked, Sean, what's your thought on a ton of secret inventory builders have that they haven't listed so as to flood the market?
We don't have any data to support that theory. If we were to look at, first of all, you can't have secret inventory, at least not in Phoenix, because if you want to build a house, you have to submit a permit.
Right.
So once you submit a permit, there's at least the notification that you have intent to build. And of course, over the last few years, that intent used to go from, hey, I might have this home in 6 months to, hey, we might build this home, I don't know, between now and 2 years from now.
Right.
Not really sure.
Right.
So the permitting activity has plummeted since last June. So we don't see any secret inventory. In fact, the inventory that is there is often, a lot of it is in the MLS now, so we can identify it there.
Right.
And especially since they are at least 20% of our active supply in the MLS. So that's not secret inventory. And then we look for anything that would supplement that supply that would put us into oversupply, possibly vacant homes. So if you're looking for anything to drag down prices, the first thing you look for is vacancies. Vacancies are the only thing that cause prices to come down. Okay, so there are a few things that can happen in order to create a vacant home. One is overbuilding, which is what we experienced, right? During
in 2008.
2008.
Yeah.
We've already been there, already done that. The builders are like, not doing that again.
Right.
So they kind of learned their lesson on that. The second thing would be, say, a lot of people losing their homes and not being able to buy another, but they still need to rent, right? So that doesn't necessarily mean that we're going to see vacancies. What we saw in 2008 was too many home builders built too many homes in relation to the population growth. That caused our vacancies. That caused a massive drop off because a lot of our false demand flip investors were pushed out. That's, it was a big old perfect storm going on there. But what we're looking at today is what could we possibly see to increase our supply and increase the vacancy rates, right? So people moving in together, two households moving into one creates a vacancy. So affordability can be a part of that. However, if you have still too many people and not enough homes, you're going to have a lot of people moving in together and you're still going to have very little vacancy. Another theory coming out, which is probably somewhat, it's valid. It's just not really clear whether or not it would cause a crash or, any massive drop off in price, is the lack of tourism. And so with any recession, which we expect is going to be called this year, with any recession, you see a drop off in tourism. That's the first thing to go. And so with that, you might see some Airbnbs, VRBOs, vacation rentals come vacant. And when that happens, they go on the market as 12-month leases or properties for sale. The big question is, will it be enough, right, to create enough vacancies to where we would see this long drawn out drop off in price? And that's debatable.
Right.
And so then you've got these mortgage rates. So the mortgage rates, stifling demand, but not eliminating the demand for homes. But now you've got all these tools that our industry has introduced to help buyers get past this initial phase of interest rates. You still have to qualify at whatever the interest rate is, but sellers can give you a year or 2 or 3 year reprieve from that in the hopes that maybe those rates will come down and you'll get a chance to refinance.
Right. Okay, here's another one. Ready? Phoenix has way overbuilt new construction, and overall home values need to drop by 25 to 30% to get to pre-pandemic values before many buyers will purchase.
The theory that Phoenix has way overbuilt is not necessarily supported by our data. One of the things you have to look at, for one, is what are we using? So first of all, there is a well-documented frustration in the housing analytic fields for the census. Okay, the census is way behind.
Because I know how much you love that census.
It's getting there. So the thing is that in order to do a valid estimate of have we actually overbuilt, or are we just counting permits as homes that are guaranteed built, the census will look at a permit and assume that's been built, when we know that that's not necessarily the case. They have permits, and sometimes we haven't seen homes for over a year.
Well, and it's funny that you say that, because I think we talked about this at another time, looking at like the vacancies, like you were talking about, and what the census counts as a vacancy. And some of the stuff they count as a vacancy, it's like, that's not a vacant home.
Right. The census will count a second home as vacant, even if the homeowner is there when they count it.
Yeah.
They will count it as vacant. So there was a report back during the foreclosure crisis that they used to call them zombie foreclosures, or something like that. They were trying to find out what areas of Phoenix had the highest vacancies, right? Which would mean the highest probability of property values declining. And the city was Cave Creek. And Cave Creek had the lowest number of foreclosures all of the cities,
Right.
and they were counting second homes, and so that study was completely debunked and worthless in the
Right.
grand scheme of things. But overall, it's debatable whether or not Phoenix is actually overbuilt. So far, that's not proving in our numbers to be the case. We're still working at seller market stuff, and we're still looking at, we do track at the Cromford Report how many people are actually short-term holds. And we don't have a lot of short-term holds right now. I'd
Right.
say OfferPad and Open Door have gone from, 5 or 6% of all sales down to 0.9% in
Which is
January.
massive because
They
they
are,
were a significant property owner in
they
the
were,
valley.
they were at one point 12% of all active listings in the MLS. Now they are only 3.7% of all active listings in the MLS. They are selling 200 to 300 a month while they're only acquiring 20 to 30.
Yeah.
So we look at things like that to see what the undercurrents are in terms of demand. And I would say at this point, we're not afraid that we have overbuilt at this stage of the game.
Right. Okay. So Richard just asked, what about deep recession and lots of job losses and people simply can't pay their mortgages?
That's interesting because let's just think about if the choices that sellers have this go round compared to 2007 and 8, when that actually happened. We, just to give a perspective, we started our foreclosure crisis in 2007. It lasted all the way through to about 2012, 13, and 14, right in there. 2014 was really kind of the end of it,
Yeah.
if you will. We reached peak unemployment at 10% in 2010. Okay. So a lot of stuff was going on there. Also understand that our industries here in Phoenix were heavily weighted towards tourism, real estate, construction, and retail. Everything that goes up together and they come down together. Today, we are a lot more diversified in our industries. While we have semiconductors growing, we have real estate retracting, we have retail retracting, but we have other industries like healthcare growing still. So there is a balance there where some people lose their job in one industry, but they can pick up a job in another industry, maybe not making the same money, but at least making the mortgage payment. So let's talk about the idea that what happens if I, as a homeowner, cannot make my mortgage payment. Right? I'm just going to throw myself out there. My mortgage payment is less than $1,000 and it's 2.99%.
And you are, your interest rate is probably not abnormal, but your mortgage payment is very abnormal.
Yeah.
Just
well, add on
a
few things, but add on a few things and just say $1,200, $1,300. Okay. For a Central Phoenix 2-bedroom, 2-bath townhouse. Okay. So here's the thing. If I can't make my mortgage payment, guess what I'm doing? I'm moving in with somebody else and I'm renting myself my own place out for what I owe. And I essentially undercut every single landlord in my neighborhood.
But you pay your mortgage.
But I pay my mortgage,
right.
And so that's one choice. I have another choice to bring on a roommate because there is enough demand out there that you could most likely find a roommate. There are plenty of services out there right now that will match you with somebody. But the fact is that sellers back then in 2007 and 8 did not really have that choice because their mortgage payments were so high that they were so much higher than rent. That
they were also in an interest only, reverse amortized, their mortgage payment would start going up. They weren't even paying down principal. Their principal was being added. I mean, it was just such a mess.
But the reality is that the many mortgage payments right now are actually below rent. So it doesn't make any sense for somebody to even just walk away. Strategic defaults, which is what we did see as well in 2010 and 11. It doesn't even make sense for somebody to strategically default on a mortgage when the payment is so low, they could easily have somebody take it over.
So you're single. So let's talk about what would you see like a family doing if they lost in the same situation, right? They lost their job. They were having a hard time paying their mortgage.
Oftentimes I see consolidation. So what we often see in times of trouble is household formation will shrink, which means you have two independent households. They move in together, share expenses. So I expect to see that type of shrinking of household formation. And that will create vacancies. But the big question is, will it create enough vacancy to bring prices down 10, 20, 30%, like what some of the exaggerated, expectations are? The expectation that we're going to drop 20 or 30% in a year just simply not supported by any of the math, any of our historical measures in supply and demand. And our historical measures have been extremely predictive. Specifically, the Cromford Market Index tells us right now that there is very little downward pressure on price unless you're in Buckeye. Or say in some of the 55 plus communities, there might be a little bit in Sun City West, but out of our 17 major cities, 12 of them are in seller markets, which means very low, if any, downward pressure on price, and most likely a slight upward pressure on price, the opposite direction.
Right.
So, and again, that's not because we have, extremely low demand. It's actually because we have this low supply.
Right. Okay. So this is a question from Sean, and I did not type this question because it's spelled the same way as I did. He said, I think what a lot of people who are wanting crashes don't realize, what if they have a crash, they probably will not have a job to purchase, which is true, but you have to live somewhere. So I think that's where, Tina, I think that's what you're saying. Like, people end up moving in together, and like your example of families, right? They might, again, move in together, and then they're all helping to pay that one mortgage. And that other family that might have lost their job, they might not sell their house. They might get rent because rent is still really high. And they might be able to hold on to that house and get somebody else to pay their mortgage and move in and save money and split the mortgage with the other family that they're living with for that little while.
Well, yes. And the other question is, well, how long do you expect that to last? See, what caused our crash in the 2006 and 7 was actually not unemployment. That wasn't what that was actually an aftermath. It was, frankly, it was Wall Street. We're going to get on the Wall Street bandwagon right now. Whenever Wall Street gets euphoric about anything and all of that money starts flooding into one section of the housing market, you start to see bubbles. And so what happened in 2005 was Wall Street got very excited over mortgages, and they started investing in mortgages. Mortgages got very, very risky. As we all remember, interest only, 100% financing, no job, no problem. The ninja loans, no income, no job, approved. All of that's crazy stuff. Very, very risky loans. We had a lot of speculators come in the marketplace, flipping homes, doing a lot of mortgage fraud. That's a whole nother story. But what happened is when that activity, when Wall Street had their day of reckoning on that, then unfortunately for the rest of us, all of that risk had been spread out across all of these mortgage holders. And they all felt the weight of that crash. This time around, though, because mortgages have been regulated, right? The mortgage industry has been very, very strict, making sure, people can afford the homes they're buying. What a concept. But now Wall Street got really excited about buying the actual homes, so you saw a lot of money being flooded into short-term holds and long-term landlords, right? And when Wall Street gets involved in home purchases, they don't necessarily care about whether or not everybody else can afford them. They just care about whether or not they're satisfying their investors that give them money and say, here, go buy houses with this, and win that. So as a result, they're outbidding the population. Now, in terms of some of the flips that we were seeing, you have an organization that outbids the population for a home, sometimes by 10, 20, some $50,000 in some cases. And then they try to turn around and sell it back to the person that they just outbid and said, would you like to buy it back from me now? And you're like, sorry, I can't afford that. I think we kind of established that, didn't we? So once they reached that day of reckoning, right, this time around, all of the risk has been borne on the shoulders of the investors, not the mortgage holders this time. They're stable, right? It's the investors that have borne the brunt of the June through December drop in prices in Greater Phoenix. Now, here's the issue. Do they have enough inventory to crash our market for an extended period of time? And we've now stated, no, they don't. Open Door has already decreased their inventory by a massive amount. They're only 3% of our overall inventory now compared to 12 in August at their peak. So that's telling us that that is a diminishing supply line for us. And we're getting back to where we would have been anyway, had we not had this big run up in Wall Street euphoria over housing.
And I think that's one of the things that I've heard a lot is people say, well, what about all the money that was printed, right? Like that's surely going to crash our market.
Well, here's the thing. Housing, has it crashed? From an industry standpoint, yes, it's terrible. I mean, we have as an industry, we have grown to accommodate at least, 10 to 12,000 escrows, closing at any one given time, right?
Mm-hmm.
We have grown to accommodate that level of demand. When that level of demand drops down to 8,500, you have a lot of people running around with nothing to do.
Mm-hmm.
Same thing with the listings. If you have record low listing counts, there's nobody to take pictures.
Right.
There's, appraisals, inspections, all of the people that are in the industry to accommodate way more listings than we have as well. They suffer. So the industry as a whole has suffered, without contracts, it's starved. The experience for the sellers and buyers is completely different though, because low supply, low demand, canceling each other out. And you're finding that the experience isn't that terrible, that the price declines now after, a lot of the excess inventory has been absorbed. It's kind of a normal market. You're in the market for 30 days before an accepted contract. That's, it's worse than 4 days of last year. But 4 days wasn't normal and not sustainable. 30 days is a little more historically normal.
Well, and I mean, our prices have been flat at about 415 since about December.
Right. Until this month, they're up about 420.
Okay.
So
yeah.
Just a little bit on that. That hasn't been recorded yet because that's as of the 30th. So when that's recorded. And
that's the thing that I think people are having a hard time just kind of wrapping their head around that. Like, wait, I thought everything was falling. And I mean, when Phoenix, when we started to adjust and we started to correct, we correct quickly. Our market, I think historically we can make pretty big movements.
Mm-hmm.
And, I think again, back to the article from the beginning, one of the other markets that they were throwing in there was Austin, Texas, which that one's also getting a lot of press as far as like, oh, that market's crashing as well. And Texas was one of those markets in the last housing crash that kind of stayed insulated from that, unlike the rest of the country. And so I think Texas is feeling that a little bit more this time. But again, I know I've got friends that sell real estate over there in Texas, and they're like, it's not what the media says. So, kind of similar to what we have here.
Well, something also to take into account is we always deal with these phases, if you will, of skepticism when you're leading in analytics, right? Your leading indicators, which we look at, is going to be your active supply, your new supply being added, your active contracts that are in escrow, and the new contracts being written, and also something that we don't have but other sources do. Things like open house activity, lockbox activity, all of that can be a leading indicator for where we believe the prices are going to be going. But when all of that starts to look positive, but all your trailing indicators are coming in and they're still representing where we were 4 to 6 weeks ago,
right?
That creates a lot of skepticism because we're saying, hey, this doesn't look so bad. But then they're still getting all the sales data coming in going, well, it looks bad to me.
Right.
Because that's a trail. Anything having to do with sales, recognizing that when a normal person buys a home, it's at least 30 to 45 days before that's actually recorded. So when you finally record it and then you have to wait for the end of the month, by the time you reach a bottom of the market, it can be 2 to 3 months before you recognize it as the bottom.
Right.
So the thing is that when all those trailing indicators come in and they're reflecting our moments of despair, right? And all of our leading indicators are indicating that we may not be, furthering this despair, if you will. I don't want to say it's butterflies and rainbows out there, but it's certainly not plummeting. Then you have this clashing of what's the word? Opinions.
Yeah.
opinions.
Well, and I
And
mean, again, it's funny because you get, and I loved Michael's most recent. Was it Michael or was it you? Your daily observation about our Crash Bros on YouTube.
well, it might have been a little bit of both of us.
Yeah, I think that's
So
good.
it's probably
I
Michael
think
that
that's
wrote it
good.
down.
Yeah. Because they are out there to get views. That's it.
Mhm.
And so they create these headlines and they say these things just to get views, and they can take the actual data, but instead of looking at it long term, they look at it short term because it tells a better story.
Yeah. So sometimes I think what happens is there's always going to be a little bit of unknown, the what ifs. Well, what if this happens? What if that happens? What if the other happens? And blah, blah, blah. And those are the fear factors, right? And
Mm,
so what you and I do is whenever there's unknown, I lean into what we know.
mm,
Well, let's talk about what we do know, and let's talk about what the numbers are doing right now. And that tells us that, at least for the time being, over the next 4 to 6 weeks, we are not going to be seeing any crashes in prices for Phoenix, right? And we can pretty much gather over the next 2 to 3 months, we're probably not going to see that from the leading indicators that we have. And so the thing is that you have this gray area of the what ifs, and that's where these types of content creators try to say, let's capitalize on that and insert our own narrative, shall we?
mm-hmm. Right.
And
Well, and I
and
mean, you have to
you can't
take that information and use it with good data and kind of
well,
assimilate it into making better decisions or better choices for you, because that's the thing, right? It's your situation might be different than somebody else's, so I can't tell anybody else what to do based on what my situation is.
well, it's almost impossible to argue with anybody who's operating in a what if situation. Um, you know, like, what if in 2 years prices crash? Well, I can only tell you what they're doing right now,
Right.
and what we can project for the near future. And we can look at long-term trends and say, well, typically if that were to happen, you don't sell your home, you hold on to it. But
Right.
if you can imagine, if somebody 3 years ago had decided that they were not going to buy a home because they thought that prices 3 years from that then they were going to crash or come down, which they did, they would have missed out on 40% appreciation
Right. Well,
because
and that's the
they were
thing, right?
afraid
So
of the
that
crash.
I have to laugh because AZ Lance says, "LOL, I watched the Crash Bros too, but then you for balance. At the end of the day, it's just an educated guess." So thank you for that. I appreciate that because
Yes.
I try to do my best with that. But I wanted to bring up this really quick because I know this is one of your favorite charts with the
Yes,
contract
yeah.
ratio, to kind of explain
Mhm.
a little bit more of kind of what's happening. So you can see this going up, and it shows you here in week 12, and just
Mhm.
at the end of last week, where we had
Yes.
a little 8,700 homes under contract, and we only had 13,000. I'm sorry, yeah,
Right.
87 under contract and 13,000
Yeah.
active, which is low for us, both
Right. Well, and
on both sides.
yeah, and the best thing about this chart is it uses leading indicators, which is exactly what is in escrow now, not closed yet. Those are future closings, and what is currently active today. So putting those in a ratio, it gives you both a supply and a demand element to tell you where are we in terms of sellers and buyers experience. So if it's rising, it's moving into a better experience for sellers. If it's declining, it's becoming a better situation for buyers. But the best thing about this is the long term. So if you click on all of your years going back to 2014 on this, then you can
Sure.
also just look at the historical nature of this and then go to just your March month. So when you go to month and you uncheck all and go to just March, you can now compare where we are today. If you hover over that last measure of 65.9 and then go to week 12 of 2019, just move over a little bit. You can see week 12 right there of 2019, 64.
Mm-hmm.
Better than pre-pandemic, but look at those numbers. So the
Right.
64 is telling you as a seller or buyer, you're like 2019 environment. That wasn't too bad. But
Right.
look at the industry is looking at 11,500 in escrow. Wow, that would have been awesome.
Right. Right.
And
That's the
about
thing. This is
19,000.
these you can't you just can't look at those months, or
Yeah, the
I'm sorry,
last
those
few
years.
years. And in actuality, in the last few years, you're looking at what's under contract was actually quite normal, but what was active was abnormal
Right.
for that time of year. And so that's what was fueling the seller market. It wasn't the
Right.
demand. So now the demand has come down. Yes, that's true. And supplies come up. It basically, you can look at that and say we were going 249 miles an hour and now we're going the speed limit
Right.
of 65, and it feels
And
very,
everyone feels like we're walking like a turtle.
yeah, it feels like a crash, but all it's really is it's a correction.
Right. So I want to bring up another article because I think it's valid. This is by my favorite person, Diana Olick, who likes to tell everybody that the market's crashing at any point of any year, and talk about luxury home sales plunging 45%, with Miami and the Hamptons hit the hardest.
We have absolutely not seen this in Phoenix at all. In fact, while they're down from last year, they're still in line with where they were in 2021 in terms of what's under contract. Now I picked over $1 million. Okay.
Mhm.
So Phoenix, $1 million's a lot of money still.
Right.
Maybe
Totally.
by Florida standards or LA standards.
Right.
But generally speaking, for $1 million, somewhere in the metro area, you're most likely going to get a custom built home. If you're going in the Northeast Valley, like Scottsdale and Paradise Valley and all of those, it's probably going to be, closer to $1.5 million to get to the custom level, right? But if you're going to Peoria or the Southeast Valley, you can still get a custom home for $1 million. So if we look at that as a gauge and look over the last few years, we're down from the last 2 years, which were crazy, by the way.
Right.
We're
Bananas.
still soaring over 2020 and every year prior to that.
Mhm.
So the only thing we've really seen in luxury is a bit of a stall. And what buyers do when things are shaky, especially luxury, if they're a little unsure of what's going to happen with, when the banks started going down and they started getting a little insecure about their portfolios and things like that, they don't necessarily plummet, but they will pause.
Right.
They just pause. So if you can imagine, same thing happens with buyers and mortgage rates. So the mortgage rates have been up and down, up and down, up and down, rocking the boat, rocking the boat, rocking the boat. So buyers, even if the boat stops rocking a little bit, they don't move right away. They want to make sure it's not going to move. But when it's rocking, they can't make a decision. So it's less about the mortgage rate and more about the volatility. If we can just get the mortgage rate to stabilize for at least 4 weeks in a row, 4 to 6 weeks would be great. Then buyers can actually, stabilize, revamp their budgets, revamp their options, see what they can get, and then re-enter the marketplace. But when the mortgage rates are going up and down and crazy like that, then they just wait for them to stop. And the same thing happens in luxury with the stock market and all of the negative news that comes out about, the security of their investments. And they just wait to see where, what's unknown becomes known, and then they can start making decisions again. But overall in Phoenix, we have not seen a 45% drop in sales in what we would classify as luxury here at all. We have seen it maintain a strength that is weaker than what we've seen over the last 2 years, but definitely strong, much, much stronger than what we've seen pre-pandemic.
Right. Again, it's the inventory, I think.
Yes.
The inventory in the luxury market is it's still low.
It's actually in the luxury market, ironically enough, it's the demand that's high.
Well, but again, in certain areas, right? So when you get into luxury, again, in the Northeast Valley, right? In the Scottsdale area, in different buyers have a tendency to really gravitate towards one neighborhood. So then it's like drilling down into that. And some of the neighborhoods in the Scottsdale area, there's not a lot of inventory.
Right.
And so I had a client that there was one house that came up and we went, and guess what? There were about 15 people there looking at it at the same time.
Yes.
And this was at $2.5 million.
Yeah. And if you get over 3 million too, you might even see a slight uptick in supply. But overall, when we're looking at luxury, the demand is still very, very high.
And I think people don't understand, or I don't know if they don't understand it, but it's that I feel like that's confusing to them because they go, well, wait a second, but the bank just failed but people feel very confident parking their money in real estate. It is a fixed asset.
Well, it is something that's tangible and you can look at, right? And if you feel like real estate better than some of these other types of investments, then you can gravitate towards that. But I think it also has something to do with the fact that we have a lot of inbound migration, and that migration now is becoming more international, especially with the Taiwan semiconductor plant being built and the executives that are coming with that and the price points that they're used to,
right?
Coming from overseas. So now you're getting into, well, what are exchange rates doing, right, and all of that. So when it comes to luxury specifically, we look at what are the portfolio is doing. So things like the stock market, we watch the stock market, Dow Jones Industrial Average, things like that. We also look at corporate profits, which, by the way, in the third quarter of last year hit another record. We don't have fourth quarter yet. It's a lagging indicator.
Right.
And then we've got exchange rates, and now we watch cryptocurrencies a little bit too, because that definitely came into play in 2021 in the luxury market, specifically here in Phoenix. And again, Phoenix is a growing city where we have people moving in and fewer people moving out. Right. And some of these other cities that are notoriously high in luxury, such as New York City and Florida and LA and San Francisco, we are relatively new. So we can move in the opposite direction from what people would expect because of the stage we're in.
Yeah. I have to say that I have to tell this story because I just saw this other agent say he was showing a $5 million house. This is not in Phoenix and whatever, but the buyer said, I want to buy the house. I need some time because I got to sell some cards. And he was like, cards? What cards are you talking about? He said, I have a bunch of Pokemon cards. I need to sell them and then I can pay cash. The buyer's agent told the seller's agent talked to the seller, and the seller said, don't sell the cards. I want the cards. So they're going to trade a $7 million house for Pokemon cards.
Wow. Well,
because my friend Jackie, who's also a real estate agent, Jacqueline in Arizona, said, didn't some inflation numbers come out today? She's been on the road. I'm not sure.
Yes, they did. And you know what? I have to look them up, and I'm going to look it up right now. I'll tell you what happened to it. So you're going to get my live reaction.
Bit, and it was the PCE, I think, was down just a little. It came down just a little bit. They were, again, it's moving in the right direction, but it didn't come down drastically.
The PCE index overall did pop up a little bit, but
maybe it was the CPI that I'm talking about.
Came down, which is what we expected. But the thing is that here's the issue. we're going to go into the consumer price index and the PCE. Okay. Bear with me, people, because this is one of those things that it's frustrating, because this is an index that has been around for eons and eons and has very rarely been improved. Okay. So let's talk about what makes up this consumer price index, which is what mortgage rates follow, and the PCE, the personal consumption expenditure index, which is what the feds follow. Two different indexes. On the consumer price index, they have reweighted it for this year to be now 44% of that index is weighted towards housing. It used to be 42, now it's 44. The problem with that is that a large portion of that index is based on something called a owner's equivalent rent. If you've ever heard that, very few people have ever heard of it. Instead of actual rents, okay, which is what people are actually paying in rent for their primary residence, we have a much heavier weight on this owner's equivalent, which means it doesn't matter what you pay in your mortgage. You could be paying $1 for your mortgage payment. Doesn't matter. All that index wants to know is, what would you rent your home for if you decided to do that? So it's a hypothetical number. And so you have a large portion of that index based on a cost that no one actually pays. Right? So there's the first problem with it. Right. Second problem is that they only take that once every 6 months. So that means that we've had 6 months of that indicator, that measure not being updated, right? Then they reweight it to weigh more now on the index. And then they take another measure, and this is now a measure that's now a year old. So we are now getting all of the rental information from the first part of 2022 filtering into this index. Now it's weighted heavier. And now guess what we're seeing those indexes do for inflation? Going up. When we have other things that are immediately recorded, such as the price of eggs, retail, gas, all of those are moving very quickly, and we get all of those measures very fast. But housing is this slow moving beast of an industry and pricing, and it takes a long time for any of the work that the feds have done to actually show up in the index. Now that's the mortgage rate one. Let's move over to the PCE. The PCE has a weight of about 24%-ish. The last time I checked, I have to look again, but it's about half of the CPI. So it's a little better of an index, and it puts a little more weight on healthcare, a little more weight, on other things. But overall, it's a little more, stable. But the same issue exists of this owner's equivalent rent that I think nobody really cared about until all eyes were on the index. All of a sudden, all eyes are waiting to get to this 2% gain that the feds are reaching for. So now every single month we're waiting to see, does it show? And all of the weaknesses of that index are coming to the forefront in terms of having to wait and now seeing these rises. And it's just a kick in the gut every time we see it, knowing that we have better data out there that could be utilized.
I was just going to say, it just feels antiquated.
Yeah. And I mean, kind of useless.
Right.
Who cares what I would be renting my home for?
Right.
When I'm actually not paying that. Nobody's paying that. So, and on top of that, on the rental side of things, if you do use the actual rents, they have to wait for all of those rentals to turn over to their new rent in order to take that, get the full impact of the changes. And so that takes a full year.
Yeah. It's a massive lagging indicator. I mean, you can't look at and get really, really great data for it.
Yeah. And that's just the nature of housing. We've talked about it. If you're going to compare housing to, say, I don't know, the stock market or the retail market or anything like that, we're this big old oil tanker. We move very slowly because of the time frames it takes for that kind of data to turn over, like 12-month leases, right? Versus, I buy, I don't know, $12 worth of eggs today, and it's recorded right away.
So crazy.
Yeah. And so you've got quite a mixed bag there on the inflation indexes, but even the feds have stated that they are expecting this rental stuff to start hitting those indexes. So they're taking some of the increases with a grain of salt. And I did read that in the press release that was, they transcribed the press releases, so you can go in there and see where he said that they know that the rental rates are going to start showing up soon.
Yeah. I want to share what we talked about just a little bit earlier with your daily observation on the foreclosure, pending foreclosures.
Yes.
And our Crash Bro friends talking about how 200% our foreclosures have gone up by 200%.
From where?
Right.
So
yeah.
The great thing about Phoenix is that we are what they call a non-judicial foreclosure state, which means that we get kind of a shot over the bow, letting us know what future foreclosures are going to look like in a 90-day notice. So we issue this notice of trustee sale that gives the homeowner 90 days to figure out what they're going to do, or they're going to go to foreclosure, go to auction, right? So these are foreclosures pending, okay? Those are the ones that may or may not go all the way to foreclosure. What we're showing here is that there's nowhere near a 200% increase in that type of activity. And I can tell you, as far as actual foreclosures that have happened in Phoenix in the month of February, they were exactly 34.
Here, I'll pull it up.
Maricopa County. Yeah, we have that. Yeah, it's under Tableau charts under the, let's see. Yeah, there it is. Those are your actual foreclosures or notices of trustee sale. So if you see the little red line on the bottom, that's what actually has reverted back to the lender.
Yeah, and in March it's showing 1.
Well, that's for March because we won't have March in yet. But if you move over a little bit, we were 14. But if you move back about, I don't know, 6 or 7 months, to that red dot, that red line, you can see you went down from, let's see, now it's all
way
through
over here.
2020. I'm looking at these little red line, that little red section. There's like one that went to the beneficiary. So if you're looking for a big percentage gain, you're looking at, if anything, that has actually gone back to the bank, and you're going from 1 to 2 to 14.
Yeah.
That's
So there
a
was
very
5.
large percentage. But then if you select all the years on this, going back historically all the way to 2002, you can see how low those numbers actually are.
It's pretty substantial.
They haven't, we started off with a moratorium, and they've never really recovered from the moratorium. Most of them are purchased way before they get to the notice of trustee sale section.
Right. And I think that this is the interesting thing, because I keep hearing a lot of people say, "Oh, just wait." Again, back to I think it was, Richard up here that said, "What about job loss and things like that?" People are all expecting like massive job loss. And I think that we could see some job loss. I mean, I just saw something today that said that Lucid was going to lay off another like 1,200, 1,300 people, which is terrible. But to your point earlier as well, you said that a lot of those people will go get a job elsewhere, because there are jobs out there.
There are jobs that can span industries. So say you're in accounting for, I don't know, for a hotel, and then you lose your accounting job. You can probably get an accounting job with an engineering firm, or any kind of, a healthcare firm. You can get different types of accounting jobs. That's one of the beautiful things about some of our professions, that can be actually, they can move across different types of industries. So you can, go back and forth. There are some that won't, if you're in retail, or if you're on the low scale, you're a beginner, if you will, on the employment side of things, you tend to get knocked off first. But at the same time, you'll probably see people who will get another job. It may not make the same amount of money, but they'll probably get another job, maybe get into more roommate situations to, kind of weather the storm, if you will. I know for me, we went through a recession in the 90s when I was in my 20s. I don't remember anything about it, because I was already poor, so it didn't matter.
Exactly. Me too.
There's a recession, like everybody else is with me now. Okay.
Right.
But that's what we did. That's what we did back then.
People,
but we do have a massive issue here, in terms of affordability in general, that, in terms of what they're trying to do on a public policy level for homelessness, and all of that can come into play. But one of the things that I think is really interesting to think about is during the crisis of 2008, 2007, 8, 9, 10, all of that, what we did not have in Greater Phoenix was homelessness. We didn't have any of that, because we had way more homes than we had the population for. So ironically enough, we had Section 8 housing tenants in brand new homes in Levine. You're renting them out with granite and stainless steel appliances and all of that stuff, because we had the roofs for them. But this go round, we really do need the roofs for the people.
I feel like the homelessness started before this happened, like before, so that I don't feel like where we are in the market right now, that's not, homelessness didn't stem from that.
No, not at all. It is stemming because you had a question earlier, or a statement earlier, that Phoenix has way overbuilt for homes. And if that had been the case, we would not have the problem we have today. So that is a symptom of underbuilding, not overbuilding, in Greater Phoenix over the last, well over a decade now.
Yeah. Well, it's crazy, but
yes. Yeah. But I mean, it's just one thing. It's one symptom to just, correlate to what we went through, and what we're about to go through, and who's going to be the most impacted. And there's a lot of unknowns out there, but I can tell you that homeowners today, in my opinion, homeowners are in much better shape to weather a recession than renters. And if we learned anything from the 2020 pandemic, we learned that if you cannot make your rent payment, you are on the street a lot faster than if you cannot make your mortgage payment.
Yeah. Well, I mean, because the owner has to make the rent payment whether you make it or not as a renter.
That's right. The landlords, they don't have much choice. on that. But when it comes to mortgages, what has come out of the foreclosure crisis is now a lot of tools on the lender side of things to help their borrowers that are in a temporary crisis, if you will, to get through. There are tools now in place that we did not have then to help homeowners specifically get through a recession or a job loss scenario.
Yeah. One of the other things that I think was great that Phoenix did was really working hard to bring in the other employment opportunities, because before we were primarily real estate, construction, hospitality, and call centers.
Yes. Low-end call centers. Now we're high-end
call centers. And now it's drastically different. I think that's great, because we now have the people that are moving here. You know, it's not just the people that are coming here buying the luxury homes that are like buying them for second homes, or that they're just retired. They're coming here because there's high paying jobs now, and a lot of them.
Well, and in fact, Taiwan Semiconductor has basically stated that ASU, they can't pull enough of the engineers coming out of ASU right now.
I feel like there's going to be some fights over some of these engineers coming out of ASU, because there's a lot of other employment people that pulled all their engineers from ASU as well.
Yeah, so Taiwan Semiconductor stated, and not only them, but their suppliers have also stated that even if they just hogged all of them, then they'd still have to hire from outside to fully support that plant.
Yeah. So last thing I want to talk about, and then I'll let you go because I know you're on vacation, is so talking about Taiwan Semiconductor, and where you stated this at the very beginning, that Phoenix is it's still relatively young, and that we have a lot of growth opportunities, out there. And we are expanding, and the city is growing. There are places like Scottsdale and things like that where our growth is kind of stifled because we just don't have a lot of land. But there's places like Taiwan Semiconductor and those areas on the west side and out in the Southeast Valley, places like that are growing. And you talk about it so well about the where the employment sectors are going to be, and how they look at it, and within a half an hour of where the real employment areas are going to be. So the growth in the valley, talk to me about where you feel like that's going.
Well, we have a wonderful resource here called the Maricopa Association of Governments. A lot of their research, because it's publicly funded, is publicly available. So it is azmag.gov, and they have a lot of interactive maps, and you can find things like employment centers and density maps and all kinds of income maps and, demographics all over the place that kind of help you figure out what direction a lot of our areas are going in. And so what we're seeing is the northern Peoria area. If you go east of I-17, there is not a lot of opportunity for new home construction there. And all of that opportunity is going along the 303. So that 303 loop, especially that area between Surprise and Taiwan Semiconductor, which is a 35-minute commuter shed, if you will. Anything within a 35-minute commuter shed of that particular plant is most likely going to be retaining its value or increasing its value over time. And so I could see expansion going out towards Whitman. Certainly Surprise. And then you also have another developing, the I-17 corridor is a established and growing employment corridor for sure. It's been going on since at least 2015.
Yeah.
But the 303 is brand new. And so that 303 is developing just south of Surprise, going towards the I-10. And that emerging center, while it might have its ups and downs, the long-term projections are very good. So we look for things like, I look for things like, is it close to an employment center? Is it close to an entertainment district? So now you have Westgate. Okay. Is it close to open space? So outdoor activities. So you can see the preserves out there towards the West Valley. You got the South Mountain area as well, in areas like Levine. Is it close to a freeway? Can you get to wherever you need to go within a 30-minute period? Is it centrally located? And I think that's it, just centrally located and the freeway access. So to that point, what we saw in Levine was a bit of stagnation. Levine had a lot of things. And for those of you who are not familiar, Levine is on kind of southwest of Phoenix along the South Mountain Preserve, on the north side. ish. And so that area was a little hard to get to in the past. You had to go through some kind of undeveloped farm areas, kind of like it was kind of a long period of time to get from the freeway down to Levine. Okay. But it did have open space. It did have the central location. It did have, it was close to downtown, so there was the employment center. Didn't really have an entertainment district though, right?
Right.
So once that 202 freeway though, because it didn't have the freeway access, once the 202 freeway was completed, Levine exploded because it fit those last two things. Now I can get anywhere I want in 30 minutes.
Right.
Now I am very close to downtown. I can get into the downtown for entertainment or for work. You can also go to Westgate for entertainment or possibly work as well, because you've got that 202 and 10 intersection, which is a developing employment center along that I-10 as well. So there's a lot of stuff going on that some areas have almost everything. And then once that last piece of the puzzle gets put in there, then boom, it explodes. And so for the Northwest Valley, that last piece of the puzzle was kind of that 303 that made things a lot quicker to get to. The Westgate development gave them the employment center. Right. And so it's still a developing area. I'm looking at for that area as we're seeing a lot more sales, by the way, over 800,000 and over 1 million.
Well, it's the same thing like Surprise. We've talked about that before. Surprise, the whole like kind of demographics and everything in Surprise are all shifting.
They're all changing. Yes, absolutely. So other areas that we're looking at for long-term expansion, of course, are going to be that Maricopa, the town of Maricopa, and Queen Creek. So the airport. Oh, that was the last thing. Close to an airport.
Right.
So you know I was missing one extra thing. Close to an airport. So now that we're developing airports at Deer Valley, we're the airport down in Mesa Gateway. Maybe they're not as big as Phoenix, Sky Harbor, but the development of those airports is definitely going to be creating a lot more opportunities in those areas for long-term holds of real estate.
Right. Well, there you have it. Tina, thank you.
You're welcome.
Thank you. You're always amazing to talk to. And you're very funny too. I forgot to mention that at the very beginning.
I don't know if I was that funny today.
I know, but she's very funny, I will tell you. I appreciate it. You are a wealth of information, and I love listening to you and talking with you because when you read these headlines talking about how the sky is falling, and then you really dive into the numbers, and you're so good at taking large concepts and making it very understandable. It really helps. And it's not that, like you said before, I am not trying to tell everybody out there that it's like puppies and rainbows. It's not, but the sky's not falling either.
Yeah. I think that in times, there's a lot of uncertainty running around here.
Yeah.
And so, whenever we get into times of uncertainty, we just try to lean as much into what we actually know, that, what do we know today? What can we reasonably expect in the short term? And that just helps us make our decisions. Because if you get into what I call it indicator overload as an analyst, sometimes something will happen and every indicator starts going off in every direction. And I consider it like fighting with an octopus. So, wriggle away from this thing and get a good look at the whole picture. And it can be overloading. So what we do is we try to lean into the basics. What's the supply? What is the demand? What is the short-term look? And make our decisions going forward, and know that the market may shift. I'm not saying that it's not going to shift. That's the human brain likes to think if it's going up, it's going to go up forever. If it's going down, it's going to go down forever. Nothing's forever in this marketplace. And so we look at where the short term is and just place ourselves in a situation where we can actually weather an up and down, aspect of whatever's ahead of us for like the next, say, I don't know, 6 months or a year, and know that there are a lot of people out there making projections that are longer than a year, longer than 2 years, and those have a very high probability of being wrong.
Right. Well, I just had a monkey walk in here.
Awesome.
One of my children. So
I saw that. So when you did this, you weren't like
I
to
know.
me. You know.
No, I'm telling him to be very quiet. So
I almost whispered. I'm like,
I appreciate your time. I thank you very much. And
"Oh,
guys, if you ever have any questions, I am always here. If you need anything, you can always find me, my number anywhere. So thank you,
yeah.
Tina. Go enjoy
Thank
your
you, Sean.
vacation.
Oh, thank you.
Thank you.
Bye.